The Reserve Bank announced an as-expected 35 bips rate hike, but stunned the market with its hawkish tilt. We've been discussing the policy with former MPC member Mridul, Saggar, Samiran Chakraborty of Citi and Prasanna of ICICI. And now we are joined by the biggest person from the banking industry, Mr. Dinesh Kumar, Khara, Chairman of State Bank of India. Mr. Khara, thank you very much for joining in. Well, I'm not asking you your own ALCO and when it will meet and what the rates will be. But do you think at the moment deposit rates also have to go up?
I think deposit rates will be a function of how we look at our asset liability mismatch. So I think we are very closely looking at it, and what the position is based upon that, if need be, we'll calibrate our deposit rates too.
Okay. I mean, until now, every rate hike meant that for the banking system, margins improved because there was enough surplus liquidity. You didn't have to push up deposit rates. In fact, the governor gave some data of 200 basis points. Only 46 basis points of hike has been passed on to legacy deposits. So do you think now it will be more, or do you think banks can still enjoy a quarter or two of good margins?
No, I think as far as margins are concerned, because a very significant portion of the book is linked to either external benchmark or to MCLR, which will actually pan out in terms of our earnings over a period of time. EBLR, of course, gets factored into immediately, but MCLR, it gets impacted over a lag of time. So from that point of view, I think we still have good time in terms of improving our margins even going forward as well. Okay. That's how I
yeah, you know, the rate of loan growth at over 17% for the industry is really steamingly fast. Now, every time the Reserve Bank points to high inflation and hikes rates, it wants the economy to slow down. Do you think this hike is enough to slow down credit growth even marginally?
We'll have to wait and watch, because this will be a function of the demand. And if at all that the demand slows down, then perhaps we'll get to see some kind of a slowdown. But I think the kind of growth which we are aiming for, this is, if at all, not 20%, but somewhere 14 to 16% is something which is a reasonable growth which should happen in the advances.
What's your sense, Samiran? This is 17% is something we haven't seen in a decade. You think it can slow down? You think growth slows?
The fact is that next year the nominal GDP growth we are all expecting to be somewhere around 11% or so. So if I apply the commonly perceived notion that nowadays credit growth tracks the nominal GDP growth somewhat more closely, then we should be coming down to low teens or around that nominal GDP growth mark on credit growth next year. And in some sense, the deposit growth should also increase from this year's level if the balance of payment situation is not as bad next year as it was in the early part of this year. So both credit growth and deposit growth should converge to some extent next year around that nominal GDP growth mark.
Okay, fair point. Since you referred to balance of payments, let me just ask that rupee question as well to Mridul. Mridul, although the Reserve Bank will say, as it ought to, that only domestic reasons propelled the rate hike, was not rupee a reason? Was not our excellent growth and consumption pushing up imports a little unsustainably? Isn't that one good reason why the rate hike is pushed and is going to get pushed more?
So, Lata, I think Governor made it very clear on this issue. He didn't say that the Fed rate hike cycle doesn't matter. He did say that the dollar sort of things matter. But he says primarily it is the domestic factors which are driving RBI to raise the rates. And that, I think, is the correct position on this. So when you are worried about dollar, yes, that could be one of the contributory factors, but not the primary factor. And clearly, as he is very clearly articulated, and all of you have noted, that the inflation target is 4%. It's assigned by the parliament. It's The framework is through the Parliament Act, and it is assigned by the government. And so the Reserve Bank would try to push the inflation down to 4%. That's the right thing to do, unless the growth completely gets derailed.
But more specifically, they may want to curb consumer imports, right?
I think that's important. Clearly, that would help rebalance the macro in a beautiful way if that happens. In this whole equation, we have to be cautious of the fact that exchange rates have non-linearities attached to it.
Okay.
And that non-linearities can play in a big way if the global slowdown comes. If you notice the data which came out of China's imports today, they have contracted 10.6% in November. That's a big contraction on top of a 0.7% contraction in October.
Fair enough.
So things are slowing down everywhere. And central banks are dialing down the quantum of rate hikes very rightly.
Yeah.
But the pivot is not the stage which can be implemented at this juncture in India.
Got it. Mr. Khara, you think the slowdown in credit demand can come from retail, or will it come from exporters and importers? Can you smell any sense of trouble anywhere, or even for that matter, bad assets?
I think exports is something which, of course, has not grown as well. So, and essentially on account of the external demand. So I think that is one sector which might witness some kind of a slowdown, if at all the global situation remains as it is. So I think that is one sector. But I think retail perhaps may not slow down. This is what my sense is.
Okay.
And corporate, of course, so long as demand is there, corporate, I think since they are not now accessing the global markets for raising loans, they are dependent more on the domestic markets. So I think we will continue to see a reasonable demand from the corporate cycle.
Okay, so
then
two final questions to the bankers here. Prasanna, do you think the cost of capital for corporates goes up? Right now, the market rates for corporates was not much higher than what government was getting in terms of interest, the spread over the government securities. You think that will rise now? There will be tightness for corporates to borrow?
Yeah. So, Lata, in terms of spreads, I think it's a fair call to take that we are still not at the kind of spreads which were in existence prior to COVID, which is, you can call it as a normal world. And the spreads are much, much lower on account of the fact that there has been a huge amount of deleveraging which has happened, and corporates have not been borrowing at all. And the government has been borrowing on the higher side. So while we do feel that the corporate spreads will gradually go up as we go forward, but the absolute level of yields, whether the cost net for the corporates is going up or not, will also depend upon which stage of the cycle we are in and where government bond yields are going. And like I said there, that seems like a range in government bond yields even now. I think the budget is what is going to set a very clear trend beyond that.
Okay, so cost of capital rises for corporates. Mr. Khara, you would agree?
Yeah, I think cost of capital will certainly be on the rise for the corporates.
Okay.
The cost of borrowing, cost of capital, both will be on the rise for the corporates.
Okay. Actually, out of time, sir. But let me ask one quick round to all of you. Is the peak rate 6.5 or 6.75? From what we know today, Mridul?
6.5 for sure.
Okay.
Rest will be forward.
Now, give me one answer. 6.5 or 6.75?
I can't give one answer because it will remain data dependent still.
Okay.
But 6.5 is for sure, and remaining will depend on how much of global growth slowdown.
Okay, I'm out of time. That's why I want a rapid answer. Samiran?
The 6.5 still.
Okay. Prasanna?
6.5.
Okay. Mr. Khara?
Function of inflation, but I think 6.5 seems to be a possibility.
Okay. 6.5 at least seems to be the answer from our guests, but they're not ruling out 6.75. It's an interesting discussion. I'm sorry the time is up. Thank you very much, Mr. Khara, Mridul, Samiran and Prasanna. And thank you all for watching.